Hi, it's Martin here from the Accelerator team. I'm here with Joe Brown again, who is one of our account managers in the accounts teams. Hi Joe, how are you doing?
Hi, all good, Martin. You good? You good?
Yeah, good, yeah. So Joe, it's been a while since you recorded the episode that we're linking to, wherever that is.
Yeah.
Well, we talked about who needs an audit solicitors wise. This is another solicitors episode. We talked about who needs an audit and we talked around that.
Yeah.
We're going to follow up with some additional stuff that I think solicitors need to know. Is it worth just recapping very briefly who needs an audit, which solicitors firms need an audit? The full details in the last episode, I get that, but is it worth just recapping briefly?
Yeah, definitely. So most firms that are regulated by the SRA pretty much will require an accountant's report commissioned within 6 months of the end of their financial year.
Which is different to the accounts.
Different
not
to the
same
accounts.
as doing a set of accounts.
Yeah, often we go side by side with each other, but it's a complete separate piece of work really.
Yeah.
Basically, any firm that holds more than £10,000 on average monthly client account balance or more than 250k in one specific month. So the reason I said most firms is you're talking one large property purchase.
Most people sell a house or buy a house.
One estate or something like that, then you're probably close to that amount anyway. So that's the main reason I say most.
So we're talking about, I mean, it must be like in the high 90s, the percentage that need this.
Yeah,
there can't be that many firms who don't get one of those.
Exactly. I mean, there are quirks, like if a firm deals in mostly family matters, if there is any legal aid monies that come into the firm, that money is sort of dealt with separately. The client
so
money.
if all you're doing is divorce work, for instance, there'd be no reason to hold money.
Yeah, exactly. Yeah.
So, but anyone buying and selling houses or doing estate work is basically in on.
Yeah, exactly. Pretty much on the right lines.
And we talked, I think, about who's responsible, but if you're a partner in a firm, you need to make sure you know who's responsible and what the rules are.
Yeah, so each
firm...
Which
might be telling people how to suck eggs here, but
exactly.
If you're new to the firm of, if you're a new partner, you need to know these things.
Yeah, definitely. I think it's every firm should have a COFA, which is a compliance officer for finance and admin, and it's their responsibility to ensure the firm's compliance with the accounts rules. So I think basically the main thing that changed recently, well not so recently, is firms had to historically submit all of their accountants reports to the SRA, but over the last couple of years it's only if there's anything, it's a qualified accountants report. So if we found anything that's like significantly wrong, a material breach, or if there's like a significant weakness in their internal systems and processes, then that does need to be submitted. But every firm...
So the work still needs to be done, but not necessarily, it doesn't necessarily always have to be sent off in the same way.
Exactly. But I think the main thing, and which I'll come on to throughout this, is there's still value in the report, and the value in a good quality commissioned external accountants report can be seen throughout.
It's not just a compliance thing to keep you out of jail, there's actual value in it.
Yeah, exactly. And in any instances where there is things that does go wrong, having a good quality report done can also help in them situations as well, which I will come on to in a little bit.
Okay, what are we talking about first now? We're talking about common reportable breaches.
Yeah, so I think, so I touched on the other one, the previous podcast that I done about a couple of issues that were prevalent at that point in time. Again, there is some issues that I've came across recently that probably one is a bit of an enhancement on the one I discussed one of the ones I discussed previously, but there's also one that has came up quite a lot over the last sort of 12 months or so.
Okay.
So that one is just specifically, I mean, you can go through the accounts rules, it itemises out everything that a firm should be looking at, but this one is specifically residual client balances. So for example, if you were buying a house, going through a firm, basically once your house is completed, you've completed the matter and you're left with a balance of 20 quid realistically.
So I've sent too much money, or the interest to settle the old mortgage was lower than they thought it was going to be. What something's happened?
Yeah, something's happened where there's just been a mismatch in what the
and it's just a nominal or a big, but there's an amount of money left.
Yeah, so that £20 or whatever, realistically, as soon as the firm has no reason to properly hold onto that funds, they should be repaid back to the client promptly on completion of a matter. Now,
so Joe, and you might be able to answer this, sorry, but from my simple mind here, on the date of completion on a house purchase, sale, or any event, really, you normally get a completion statement that sets this out, don't you?
Yeah, exactly, yeah.
How would that accidentally be left there then?
It can be a number of things. If, for example, because a law firm can pay out quite a lot of disbursements on behalf of the client before the money is recouped from once you pay your fees, etc. Right. So if any of that money comes back from and disbursement funds get refunded later down the line, or if there is just literally a mismatch on the completion statement, sometimes they do need to get
just miss something.
Yeah, or sometimes they do need to get amended. But ultimately, if there is a residual balance on there, that should be repaid back to the client when there's no reason to hold on to it.
Okay.
Now, where that becomes an issue is when your £20 turns into another £20, then gradually you're accumulating quite a lot of very small balances,
you which turns into a couple of thousand 20 quids.
Yeah, exactly. And I think there's been a few cases recently actually in tribunals where there's been issues identified as part of the accountant's reports, been notified on a couple of qualified accountants reports that you need to look at doing so.
Then change your systems.
Yeah. Or we like if, for example, we were commissioning that report, we would expect to see some progress of them balances being dealt with.
So if you went and did the report the next year,
you're
in a tricky position because you've got to go, well, you've clearly ignored what we said last year, it's still happening.
Yeah, exactly. And there was a couple of cases where one was where there was like over 380 client matters totaling balances of about £600,000 of client account residual balances.
So it's not just 20 quids then,
so yeah, that's exactly what I'm saying.
So actually that's someone sitting on a canny bit of somebody else's money, isn't it?
Yeah, exactly, yeah. And I think in that instance as well, it was identified as part of the accountant's report for 2 years, no progress was made. Then it got obviously qualified accountant's report. Then on that instance, the firm actually got fined £25,000, incurred 20k of legal costs, and actually got like strict restrictions imposed, which when you think
on the work they can do.
Yeah, on the work they can do, and also because they had that many client balances to go through. Obviously, I've talked about the tangible cost of that. Yeah. But given the fact they had to correct that in a fairly quick process,
basically took a worker off their job for weeks, presumably.
Exactly. So you think of the knock-on impact.
You've lost a couple of months' worth of wages or earning fees.
Yeah, exactly.
Wow.
Yeah, I know. Yeah. So
actually, because that's like I say, that's a lot of 20 quids, but that's also like. There must have been some decent individual tallies in there.
Yeah, exactly. Yeah, and I mean there is
to get up to that number. There must have been a couple of 4-figure, if not 5-figure residuals.
Yeah, exactly. So I think obviously on a few of them, all you basically need is one sort of probate matter that you can't find the beneficiary, or realistically that matter should still be active at that point in time. But also, if there is reasonable steps being taken to identify them, but they just can't physically pay that money across.
Because you qualified the opener here with once you've got no reason to hold the money, you're still looking for a beneficiary. Well, you've got a good reason why you're holding it.
Exactly. Yeah.
What you then said as quickly as possibly or soon and promptly.
Yeah.
Any guide on what promptly means?
I mean,
there's not a day, is it?
There's not a day. I mean, historically there was always like a 14-day rule within law firms, so we sort of say within a couple of weeks can be quite prompt. But I think
because that gives your internal finance team a week to flush most things out, to go, oh, why is there any money on there, that matter's closed.
Yeah, exactly. And I think it's all about sort of reviewing the internal processes, making sure that there is something in place, that the firm or the coffer is identifying these balances that haven't moved. So quite a good thing is given that we've got everything more digital now in terms of case management and stuff like that, there are software out there such as Leap, Quill, etc., where you can actually run reports pretty easily saying this balance hasn't moved for 12 months.
And there's been no movement on the job either.
What's happening with that? And then, so basically what we would come and say as an external auditor coming in to look at it, is there any balances that there is no reason to hold on to it? If so, has the client been notified, and has there been any steps taken to address this?
What if you can't find the client?
Yeah, so there is reasonable, there's a bit of guidance of what you need to do in that situation there. I mean,
I presume you should be actively trying to find the client.
Reasonable.
It's pretty unusual not to find someone who you...
Yeah, so reasonable steps, there is actually quite a large definition into reasonable steps. So there is like agencies who you can use to track down and trace people.
You normally find to try and collect money on the rather than...
Yeah, exactly, yeah. But there is agencies you can use, and I think definitely in the case of like quite large estates where there's quite a decent sum of money going to people.
Yeah.
But I think it's all down to the firm to justify what reasonable steps they've taken out.
Yeah.
There is, if you have got to the end and you literally can't trace them, any individual client balance under £500 you can choose to pay to a charity of your choice, or any balance over that you can write to the SRA for approval to do so as well. So there is options you can do to make
You're
sure
not just stuck with money forever,
Make-
continually trying to find it forever.
yeah, make sure your balances aren't creeping up to £600,000 to a certain degree.
Yeah. What happens to the interest on that money then?
Yeah, so
I presume they're making, certainly now that interest rates have all gone up again, I presume solicitors are starting to make an interest return on these balances.
exactly, yeah. So there's interest. The interest they earn on client account can also is also treated as office money, so their monies. But each firm, and it's probably like as you mentioned there actually, it's becoming more prevalent that with the interest rates rising, the firm should have a proper interest policy written up on how they account for interest on client account.
Yeah.
So realistically, if them funds were sat in a bank account, they would be earning interest on that.
So I remember back pre-2008, which
Yeah.
is the last time we had any interest really. You know, we had clients who were getting 200, 300, 400 grand of interest received and were paying out, let's say half of that. You know, they're paying decent amounts out to clients. Is there a stipulation on the amount of interest you have to pay out to a client? Or?
At the minute there isn't. It just needs to be a fair and reasonable policy, and it needs to
So
be
you're getting interest on someone's money.
Yeah.
Seems fair to give them that interest, doesn't
Yeah,
it?
exactly. I think when the interest rates were so low, like you're talking 1-2%, it wasn't as
wasn't
material.
worth it.
But now, like you're saying, and I guess that is also if you're looking at it from a risk point of view, is there a temptation to leave them funds on client account because in the firm earn a bit of interest on that? Realistically, I mean, there was also another case where a tribunal case as well, where there was what we were talking about, a estate case where the final beneficiary could not be located,
Right.
and the firm was actually experiencing some cash flow difficulties, and they were transferring that money to office account to pay for their VAT and payroll bills. Now that was dealt with really seriously by the SRA.
Because that's pretty.
Yeah, there's quite a lot of accounts rules that is in breach of.
It shows you're just not running your firm properly.
Exactly, yeah. So I think overall, it's just, like you say, the whole idea of these accountants reports, and if you were going to use a solicitor, is your money going to be safe while using them? Do you know what I mean?
That's why it's all in place.
And that's why it's all in place. And in both of these instances, I mean, I'm talking pretty hefty fines there. Both steps of these was referred on through a qualified accountant's report, and the SRA take that into account as like a mitigating factor. So actually, by having that accountant's report behind them and doing like a self-report, it reduced those fines downwards. So,
which sounds counterintuitive, doesn't it?
Yeah.
So like, no, they report 2 years in a row. Yeah, but at least we know that you care about it a little bit.
Yeah, exactly.
It's a bit of a weird one, but yeah.
100%, yeah. Exactly, yeah.
That's interesting.
Yeah.
Are there any other examples of common things that are like starting to crop up that weren't covered last time?
Yeah. So there was one matter that came recently as well. I mean, it is one that I touched on the last one, but it was only very briefly. It's where a firm provides banking facilities. So basically, if a firm should only really hold on to client monies for the matter that it's instructed to do so.
Yeah.
So if you're buying a property, all the funds that the firm is holding on to on behalf of that should just relate to that sale or that purchase.
I shouldn't just randomly send them an extra 50 grand because I'm planning on buying a Land Rover in a couple of weeks and I want them to hold the money. Or they're like, yeah,
exactly.
That's why I went there, but
no, you're on the correct wavelength, because the reason that's not looked into favourably is you sort of lose the audit trail of that money, and you can get yourself in terms of money laundering, all that sort of stuff. You actually need to know.
The reason I went Land Rover is I think there was a case many years ago of a solicitor being struck off because they knew that a client who'd bought a Land Rover cash.
Yeah.
And that was sufficiently red flag enough to go, no one buys a 50 grand car cash.
Yeah, exactly.
You should have reported that.
And
I think that's why I went Land Rover.
But as well, actually thinking about like doing so through your law firm that's acting for you.
Why would you give your solicitor money to buy a car?
Yeah,
unless you're trying to hide it from someone.
Yeah, exactly. And that situation is also another case I got found recently as well, was where the firm was basically, they had like 50, 60 matters ongoing for this one client. And it was basically just, can you hold on to that money just because if something's going to come at some point.
I'll need it again, or yeah.
So that's keeping it within a firm that basically is keeping that safe for you really until they actually subsequently need it. The reasonable excuse was given was actually he's one of our best clients and we want to appease him.
We wanted to do what he said.
But actually from a risk point of view, there's no, if you go back to the rule what I mentioned earlier, the fund should be repaid when there's no proper reason to hold on to them. Is there a real reason for holding on to that money, or is it
just convenience, I suppose, in this example from what you're saying? But
yeah, exactly.
But also, bank transfers are easy enough these days, aren't they?
Exactly. Yeah.
Anything else cropping up a lot?
I think probably like a general one really, and I think as we can see from most businesses is when you've got your local branch closing for your bank. So if you've got clients that come in and pay like cash, which is quite seen in law firms if they've got like a will matter or like very small cases. There's been issues about how you go about banking that cash.
Right.
So it's basically like...
So what people now is taking elaborate ways to get money to where it needs to be because they can't go to their branch.
Yeah, so like, it is inconvenience for quite a lot of businesses, which has been seen with all these local branches closing. But there is steps that you can take to make sure the money goes into the right account. We have had questions of whether, like, can we bank it into our account and put it back into the business?
Because you might be tempted if you're a sole trade solicitor, you might say, well, it's what kind of within my control. I'll just put it in my personal first direct account and transfer the money.
Yeah, I mean...
I presume that's the kind of thing people end up thinking, I need the money in somehow.
From a risk point of view, it does give rise to a definitely increased risk from what we would do the inquiries as part of it. I mean, anything that you feel doesn't feel 100%, there is an ethics helpline for the SRA who you can speak to quite anonymously and they can give you their thoughts on it, to be honest.
And I presume if you spot something on an audit and they say, well, there's a file note of who I spoke to and a case reference number from the helpline, that's why we did it.
Yeah.
Well, at least again, you can demonstrate why you did something, can't you?
Yeah, exactly.
Even if it was wrong, you go, yeah, but they told me to do, like...
Yeah, 100%. I think it always goes back to that conversation. You've got something to refer to.
Keep the evidence all the time.
I think when something doesn't feel 100% natural, such as banking client money into your account and then putting it back in, like, are you actually putting it back in, or is it like if it doesn't feel right? My honest opinion is just to reach out either to your external auditor for an opinion or the ethics helpline. It's
funny, Joe, it's not the same thing, but people say to me quite often, do I need a separate bank account for my business? And I always just say yes.
Yeah.
You don't legally need one unless it's a limited company. But if you're a sole trader buying and selling tables on eBay or whatever the hell you're doing, I always just go, why would you not have a separate bank account? Why would you not have one?
I think it just keeps everything separate.
It's just so much easier admin, isn't it?
Yeah, exactly. Yeah. And it saves questions there, like do you know what I mean?
Because a lot of people don't realise, again, off topic slightly, but the reason you keep it separate is if the Inland Revenue say, I want to see your bank statements, you've just got to give them the business bank account.
Yeah.
It just keeps it contained. You haven't got to explain like what that 400 quid cash was you got off your great Aunt Betty who you paid in on the 17th of March.
Yeah, exactly.
In your personal account will go, well, that's taken, isn't it? Like, just separation is always just easier from an admin perspective.
Yeah, and I think just touching on, again, anything like any business that holds client money, inherently there's a bit more risk there.
Yeah.
And I always think, like, how would your client feel if you put that straight into your bank instead of the firms? And
probably I think there's probably a lot of ignorance amongst clients and customers of businesses where they just think, well, surely I'm protected. How many people have bought a sofa, put a deposit down on a sofa and they've gone bust and they don't get the deposit or the sofa? And you think, well, that's surely client deposit, that should have been protected. But so you can't presume these things, can you?
No, you can't. And I think, like I say, all the year-end assessment is the client money kept safe? Is there anything that we can suggest to improve the processes? But ultimately, all I'm getting at here is, rather than saying here's everything that could go wrong, just extreme, probably to a slight extreme. If you don't have good controls and systems in place to identify these things, naturally you can get to a situation where there's quite a big, larger problem.
Well, put it this way, on the residual money thing earlier, if you were sitting there and someone went, oh yeah, we're probably not as great as we should be on that, and if you tallied that up and got sick, I would imagine you would be really surprised that you'd found 600 grand not out, wouldn't you?
Exactly, yeah.
That would you would go, hold on, major worries here. Because if you can accidentally sit on 600 grand,
Yeah.
What else can you accidentally do? So
Yeah,
that would
exactly.
be a massive red flag.
Exactly, yeah.
Just out of interest, Joe, then, solicitors will be watching this, but just in case, you like restrictions on trade, etc., how would a punter figure out if someone is doing these things right?
Yeah.
There isn't really a way to do that, is there? Or?
Well, no, but what I would say is on the cases that I mentioned earlier about like quite severe cases, in each of them they all get published online. So as well, again, I mentioned like in terms of a cost implication of things going wrong.
There's reputational damage there as well.
There's a reputational damage of it as well. So I would just say
not only not going to be able to do that work, but anyone else reading it's going to go, oh, hold on.
Yeah.
Dave's been up before the SRA.
Yeah, exactly, and it will be published. It's readily available online. Yeah. So that's also a thing for the sisters to consider. But I think for
if you're a client, I suppose in theory, if you're going to send anyone a big wedge of money, as a minimum, make sure they're not on that list.
Yeah, but let's say these firms can take steps to improve. Do you know what I mean? It's a very much isolated case, but I think just do your research on the firms you're looking into, as well as that. Just if you've got anyone that reputable that you know as well who works closely with any of them, just lean on their advice as well.
Yeah. What's coming up next then, Joe?
Yeah, so I think
updates on other things.
Yeah, sure. So I think this is just a very brief update on any firms that are heavy in terms of conveyancing work that they do.
What we all know what do you mean by heavy?
So heavy,
90%.
So just where
they just do a lot of it.
A lot of it, yeah. So I think if you've got a lot of it,
so it could be 5% of their business, but they're doing a lot of it.
Yeah, exactly. Right? Yeah, exactly.
You don't just mean people who are exclusively conveyancing.
Yeah, not people like exclusive conveyancing, but any firms that do a lot of conveyancing work, really. So historically, like if these firms who have more than one partner, they could have access to being on a panel membership.
Yeah.
So that's when they can act for both borrower and lender in a transaction. So what that means is basically when you're buying a property, you can use them, and if they're on a recognised the panel list, there isn't additional costs associated with using that lender. So if you come, I've got a mortgage with a certain bank. If they're on the panel list for them,
they're recognised as someone that they know and trust.
They can use them really, and there's no additional cost for being with a certain lender, etc. There is other criteria, but I won't go on that too much at the minute. But I think basically there's been so I think this also ties into what I'm going to come on later, just about the structure of your firm and whether if that's still the right place for you to be. If you are retiring partners in and out the business, so most panels, lender panels, will require 2 partners to be on it in the firm to be recognised on the panel list. Some of them are even up to 3. Now, if you're going through any structure, so these solicitors must be regulated by the SRA, so recognised SRA solicitor. Yeah. But there are others that you can be recognised with, but there's just a bit more work into it. So I think more than anything, the main reason I said heavy conveyancing is if you're quite reliant on being with these panels.
You need to be on the panel
to be able to
don't drop off the panel.
Yeah, otherwise you're conveyancing.
But what's the change that's happening there then, Joe? Are they now getting stricter, or is it getting harder to get on the panels?
Yeah, so there's a lot of checks that they do to the law site, which I think has always been prevalent, but I think also it's in line with Companies House and how you're showing your firm on Companies House as well. Right. So the process. And it's not like a warning or anything, but if you do have a retiring partner, someone that you like to bring in, it's important to make sure that not only are you complying with the Companies House, HMRC, but that you're also compliant with the panel requirements if that's needed. Because
it's just another thing to think about, isn't it?
Yeah, and I think the reason why I'm choosing to mention it is because often that can get overlooked, and it can lead to potential issues down the line. For example, if you have to come off a panel, what's that impact?
How often do these panel people check to make sure you're still qualifying, and
annually? Usually it's an annual subscription.
So you might think it doesn't matter, but when you come to renewal and they go, oh, you had whole of July, we're not going to renew you.
Yeah.
So you might kind of get away with it, but they'll catch up when you do your renewal, won't they?
Exactly, and most changes that you make to your structure, not only have you got to submit them with Companies House, you've also got to submit them to the SRA for approval. Yeah. You then also have to let the panels know. It's not as if it's an overnight change, and it's something that you just need to be aware of, really, especially when you've got that sort of succession planning.
I presume there's even a semantics issue about whether you've got the right number of people there on the day, because you might have an outgoing person goes day 1, incoming might not be there till day 2.
Yeah.
Well, technically on midnight, nobody was on, like, maybe I'm overthinking this, but...
No, you are correct though.
Like, if anything, go for overlap rather than a gap.
Yeah, exactly. It's just to make sure you've satisfied the requirements, and then you've got more time to digest what you're actually looking to achieve from your one coming in, one going out, etc., etc.
You shouldn't really do any of these things on impulse anyway, should
no,
you?
No.
I know things happen and occur where you've got to do things fast.
Yeah, definitely. And I think there is advice out there and guidance to lean on. I mean, the whole process throughout it can feel quite slow and drawn out, to put it quite lightly, but I think it's always good to make sure that everything's planned so you keep compliant with who you need to be compliant with. Yeah. You
mentioned before about you were coming on to is you've got a correct structure.
Yeah. So
what I suppose, is it worth stating what they are first?
Yeah. So I mean, more like just this element really is just to make sure that quickly cover if you feel like you've got the right structure in place for your firm at the moment. So obviously, depending on the size of the firm, it can be quite varied. I mean, if you've got the smaller independents, they're usually quite happy to go as a sole trader, limited company, etc. But then,
so you've got a one-person business.
Yeah.
There's a profit decision based on tax and liability, whether you should be a company or not.
Yeah.
But you could just as happily exist as a sole trader, no bother.
Yeah, exactly. You can do. Yeah,
that's self-employed. Yeah.
Absolutely fine. I think again, just with touching on what I mentioned about the panels, if you're a conveyancing firm, the sole traders, the panels don't normally recognise them, so it can be quite a bit more costly for them.
Do you know the logic on that then, Joe? Because if anything, I would think, well, you're a sole trader and have your house if it goes wrong.
Yeah.
I would think that there was more stuff to get my hands on with a sole trader rather than a company. Do you know
I would say it's, yeah, I mean...
Or is it just to think, oh, you're too small?
Yeah.
You're probably not sophisticated enough.
I think it's probably a combination of both, as well as with, I mean, you've touched on risk really.
Yeah.
From a panel side of things, if it's just one partner, is there a bit more risk there?
Too exposed to risk, isn't
it?
Yeah,
so maybe from that. But like I say, it has always historically been like the two partner or two director, but now it's becoming more like three, depending on who you want to be with.
Right.
But yeah, I think just in touch on the structure, so you've got your sole traders, partnerships, limited company, and also one that it's been really common over the years has been an LLP as well.
Yeah.
So obviously with all the profits from if you were a normal partnership, go straight to individuals, as partnership as well, individually liable for anything that's going on as well.
Yeah.
The LLP element gives you that sort of limited liability while still
having a profit share.
Yeah, exactly. Yeah. So
because a lot of people don't. I mean, I would hope most of our audience listening would realise, but in a normal partnership, you're jointly and severally liable for all each other's stuff, aren't you?
And I think that's especially when you've got instances where there's like a property involved or stuff like that. There's a lot of things to consider.
You don't want to lose these things, do you? Whereas the LLP gives you another layer of protection, don't you? You can only lose your part of it, really.
Your part, your capital account, what you've earned and what you've got still to be taken.
You're not going to have to, lose your house to pay their other stuff off.
Yeah, exactly, yeah. And I mean, I think there's, I'll probably say indicators where you feel like it's, it might not be the right structure for you no longer. I would say, one, if you feel like you're paying a bit too much tax, I think
it's worth looking at.
Worth probably having it. If you feel like you're paying too much tax, probably a good opportunity to speak to somebody like us to say, do you agree? If the answer is yes,
can be done?
If the answer is yes, maybe we can.
It's hard because a lot of people also spend all of their money.
Yeah.
So you don't normally really do much with tax if you're not spending all of your money every year.
Exactly, and I think
it's a loose rule of thumb.
I think once as well, like if you have had a few years where your liabilities have been quite high, and you're in that system of paying quite a lot in terms of July payments on accounts, it's quite difficult to then catch up to a certain degree. Because
you need the money out to pay the tax.
Yeah, so
even if you've reduced your spend, you've still got to pay the tax, haven't you? And that money has to come.
Yeah, there can be issues as well, like if you've got a capital account imbalance, so you've got one partner who's been quite a heavy drawer and another one who's been quite prudent in their money. There's a conversation that needs to be happening.
At some point, there's a
yeah.
Because if the partner who's got a massive capital account leaves, how the hell is the other partner who spent all of their money that they're not building up any more reserves to like pay out the old person?
No, 100%. Yeah. So there's a lot of things.
We've seen that quite a bit over the years, I think.
Yeah, 100%. Yeah, I've seen that definitely quite a lot over the years.
I'm sure we had a client who, I'm sure the senior partner was owed, I'm sure it was like 6, 7, maybe even 800 grand.
Yeah.
And like, he kind of almost couldn't leave the business because it was like, well, At those levels, you consider doing weird things like, well, why would we keep working when we need to give you 800 grand?
But I think more than anything, there is ways out of that situation. And I think it just comes to that point where
planning,
and I think that's where
don't retire impulsively.
Don't retire impulsively.
Plan them in ahead. Yeah.
Succession planning, exactly.
But also make sure that people are taking out equal sums.
Yeah, 100%. Yeah.
Because, I know you don't need the money, but also if you leave it in there, it's at risk.
Yeah, exactly.
So you should really be taking it out.
Yeah.
There's also a fair argument, I think, to say, Joe, that if the business can't afford to pay you out the money that you've already earned and is after-tax profit, then maybe everything isn't working well.
Yeah, exactly.
You should be able to draw the money that is your money.
Yeah, I think always having a balanced capital account and in what you owe from a partnership is always the best way to be, especially in a firm, in a law firm, to keep your thrones equal. I appreciate some things can get in the way sometimes if you owe a certain amount and more needs to be drawn.
You've got one greedy partner.
Or life gets in the way sometimes, do you know what I mean? And there is a need for that cash. I think just touching on that as well, there has been some developments lately in terms of if you're an LLP and you've got a salaried member in the LLP. So, for example,
as in like a fixed profit share.
Fixed profit share, yeah. So basically, if by normal in general, really, if you're a member in an LLP, you tax through your self-employment on your return. There are conditions in place really to say that and it's only recent changes really, that if you do have a member in the LP who gets a fixed profit share, are they actually employed by the firm?
Probably, because there's, I think they came in a while ago, mind you, but not many people see them. But it causes issues. So one of the reasons we aren't still in LLP was the way that we brought in new directors. Because you're basically an employee, and it was going to cause havoc with the LLP structure. Yeah,
so I think more than anything, just to touch on that really, if you do have any members in your LLP who are on a fixed profit share, probably an opportunity just to have a quick think about it and maybe get in touch with us.
Because you might be getting it wrong.
Yeah, you might be getting it wrong, and I think obviously
with tax bill you didn't realise.
Yeah, exactly. I think on that as well, it's obviously the Class 1 ENI that you won't necessarily be paying on the fixed profit could then be incurred really. So
okay, well listen, Joe, is there anything else?
No, that's all really.
What are solicitors keep just getting wrong at the minute? I know you've mentioned the breaches and that, but like not SARS. What are solicitors just doing wrong at the minute? What give them a tip?
I think more than anything, I won't go into what they've got wrong, but I think if you feel like something isn't quite 100%, or you feel like you just need a bit of reassurance on something, we've got the legal team here, as well as that the SRA professional ethics helpline is really useful. They can give you some really good impartial advice, but like I say, we'd be more than happy to review that scenario with you.
Who's most likely to feel that then? Could that be a junior partner joining an older firm where they think, is this how it's meant to work? Or who do you find has the most?
To be honest, I think change is always quite difficult, and especially if you refer to them firms where you've got someone who's done it quite a lot of the old-fashioned ways over the years, and you've got all this use of software that's come in to keep digital files, all that sort of stuff.
Actually, any transition, if you're going from paper files to a digital thing, it's very easy for stuff to be lost there, isn't it?
100%.
It's very hard to replicate it correctly on day one.
Yeah, and there is a requirement to keep track of them records for up to 7 years as well. So I think it's a case of just making sure we've got basically if there is any change in the firm, it's the same with everything really. If there is any change, it's how we manage the firm and the business through change really.
Good. Thank you very much, Joe.
No problem.
I hope you've enjoyed that. Like I say, Joe has been on before. He talked about a lot of things. We've mentioned the previous episode. We will link to that. We'll also link this one to that one. So hopefully people can have a good couple of hours of catching up on solicitors' rules.
Cheers, Martin.
Thanks very much, Joe.
Cheers.